The 2008 global financial crisis was a systemic collapse of the international financial system that unfolded after years of excessive risk-taking, deregulation, and imbalances within the global economy, ultimately becoming the most severe economic downturn since the Great Depression of the 1930s. At its core was the U.S. housing bubble, fueled by historically low interest rates following the 2001 recession, aggressive lending practices, and a widespread belief that housing prices would continue to rise indefinitely. Banks and mortgage lenders issued vast amounts of subprime and adjustable-rate mortgages to borrowers with weak credit histories, often requiring little or no documentation of income or assets. These loans were then securitized, packaged into mortgage-backed securities, or MBS, and more complex instruments such as collateralized debt obligations, or CDOs, and sold to investors around the world, spreading risk throughout the global financial system while masking the true level of danger. Credit rating agencies played a critical role by assigning high ratings to many of these securities despite their underlying fragility, enabling banks, pension funds, and insurance companies to hold them in large quantities. When U.S. home prices began to decline in 2006, the entire structure unraveled. Adjustable mortgage rates reset higher, monthly payments surged, and millions of homeowners defaulted on their loans. As foreclosures increased, housing prices fell further, creating a vicious cycle that wiped out household wealth and rendered mortgage-backed assets nearly worthless. Financial institutions that were heavily leveraged and dependent on short-term funding suddenly faced massive losses and liquidity shortages. The crisis escalated dramatically in 2008 with the collapse of Bear Stearns, the bankruptcy of Lehman Brothers, and the near failure of American International Group, or AIG, whose exposure to credit default swaps threatened to bring down the global insurance and banking system. Government-sponsored entities Fannie Mae and Freddie Mac were placed into conservatorship, while banks across Europe and Asia faced similar stress due to their exposure to U.S. assets. The fallout spread rapidly to the real economy. Credit markets froze, businesses could not secure financing, and global trade contracted sharply. Stock markets plunged worldwide, wiping out trillions of dollars in wealth, while employment surged as companies cut jobs and investment collapsed. In the United States alone, millions lost their homes to foreclosure, household confidence cratered, and entire communities were devastated. The crisis quickly became global, pushing many countries into deep recessions, sovereign debt crises, and prolonged periods of austerity, particularly in parts of Europe. In response, governments and central banks launched unprecedented rescue efforts to prevent a complete financial meltdown. The U.S. implemented the Troubled Asset Relief Program, or TARP, injecting capital into banks, while the Federal Reserve slashed interest rates to near zero and introduced quantitative easing to stabilize markets. Similar measures were taken by central banks around the world, alongside massive fiscal stimulus programs aimed at reviving economic activity. While these actions helped avert total collapse, the recovery was slow and uneven, leaving lasting scars such as increased inequality, public anger toward financial elites, and a deep erosion of trust in institutions. The crisis ultimately reshaped global finance, leading to tighter banking regulations, stress tests, and capital requirements, while also serving as a stark reminder of the dangers of unchecked leverage, financial complexity, and weak oversight in an interconnected global economy.